Hi everyone and welcome to the weekly update with me, Rich Perry, market analyst at Tech Markets. Each week I take you through the key events that I believe will be driving your investments in the coming days. Now, certainly this non-farm payrolls report on Friday has sent shockwaves through the market. The market is now starting to anticipate an earlier than expected rate hike, and that has driven the dollar strongly higher, and that has also put equity markets under considerable pressure. Now, this has been driven by this non-farm payrolls report. This came in ahead of expectations at 295,000 jobs, but also it contained an employment rate falling down to 5.5%. Now, this is interesting because the markets are now factoring in an earlier than expected rate hike in terms of probably, and I say probably because it's around about 60 or 70% now chance of it being in September and perhaps even June. Now, what is the impact that we're seeing across the markets? Well, we're seeing treasury yields spiking sharply higher. Now, this is certainly, as you can see on my slide here, it's certainly a move on the treasury yields on the 10-year to well above 2% now. And the actual next key resistance level comes in at 2.4% on that treasury yield. And we're also seeing the gold price sharply lower and also equity markets falling away. So a big impact across the markets being felt by this payrolls report. I've got my own opinion in terms of what I think about Fed rates. I think that the market is over-egging it. I think that they're not paying enough attention to the average hourly earnings number that continues to remain around that 2% annualized level, showing no real pickup in wage growth in the States yet. And I think until that happens, until you start seeing average hourly earnings picking up, I don't think the Fed is going to raise rates. It's quite a hawkish Fed in terms of composition anyway, and I think it gives it a very good excuse to hold off. And I think that the market is going to, towards the middle of the year, I think it's going to be slightly disappointed by this. Now, what are we going to do in the meantime? Well, I think there's a lack of data, a lack of really market moving data through this week, maybe retail sales, but apart from that, nothing too significant. Now, I think that means that the market is going to be moving towards this Fed meeting in about 9 days time on the 18th of March being the next time that it gets a real signal from in terms of interest rates. So that would suggest that we're going to see some strong dollar moves in the next few days. Now, there may be an interim slight dead cat bounce to be seen. In fact, that's what we're seeing pretty much across the dollar today, but I think it's going to be short-lived, and I think we're going to see further downside pressure on some of these forex pairs. So what about these forex pairs? Well, we are seeing euro dollar, for example, sharply now below the $1.10 level, and it's actually bounced from support at 108.20 this morning. Now, I think that, as I said, is going to be a dead cat bounce. I don't see it going too much higher in terms of recovery. I think that any sort of rally is still going to be seen as a chance to sell on euro dollar, and I think further downside will be seen. The next support comes in at 107.60, and that is a level seen back from 2003. So big downside still potential, and to be honest, that wouldn't really be classed as great support anyway. So the prospect of further lows and further downside on euro dollar is quite high. Similar sort of story on cable. Further downside I think is going to be seen. Cable actually bounced from just above a key support level though, for 149.50 to 150 big level of support there from December and January. And I think that the rally that we've seen in cable just minorly today, I think any sort of chance to sell around that 52 figure mark would be ideal. But I think we're going to see further downside in this cable chart. I think it certainly looks like the momentum has turned negative now. Now, also in terms of dollar yen, quite a decent looking chart now. Dollar yen, it's broken out above the 120.82 level, and it's actually now opened the key December high of 121.84. Now, you've got across the board nice strong momentum indicators, pretty well orderly uptrend as well. So it looks as though any sort of weakness is again a chance to buy. I think anything around that 120.20 towards 120.50 level, it looks a fairly decent buying opportunity now, with further upside likely to be seen on this dollar yen chart. So across the indices, well, as I said, indices came under a bit of pressure on Friday. The market was seeing that the potential for Fed rate hike sooner than expected was being taken as a negative for stocks. And normally you'd see positive payrolls number being a positive for stocks, whereas on Friday we saw it taken as a negative. Now, that could mean that strong US data in the coming months would be deemed as a negative for equities, potentially. So we saw the S&P 500 down 1.4%, completing a small top pattern that actually gives it an implied target of around 2040 towards 2050. So we could see further weakness in the near term on the S&P 500. Now the DAX is different actually, because we're seeing the DAX supported by quantitative easing. That quantitative easing comes into force in the Eurozone on Monday, today, and the DAX continues to be supported by that. Outperformance on the DAX continues. Now I think that's going to be ongoing over the next few months, and I think that could be an interesting pairs trade actually, with that positive DAX maybe versus being played off against the negative FTSE. And the negative FTSE is because it continues to remain anchored. It's not really broken out. It's still struggling. It's actually corrected back again. And I think that the support near term comes in at 68.59. However, there could be a drag back towards the 67.33 level, which we saw a few weeks ago. So FTSE is looking under pressure. Okay, so what about gold? Well, the gold chart is in a bit of a corrective phase, and what we're seeing is the medium-term bears in control to the downside, and this downside is being dragged through the floor of the 1168.25 level, and the bears are in control. Now, any sort of bear market rally I think you get on this is probably going to be seen again as a chance to sell. Strong dollar is weak for gold, and that continues to be the case at the moment. So anything that you see back towards the 1180 towards 1190, I think should be now seen as a chance to sell. So what about the forex calendar that we've got in the coming week? Well, as I said, there's not a great deal going on this week. We've got a little bit of Chinese inflation on Tuesday morning. That could have an impact on the commodity currencies. And then we're looking out for the the RBN Reserve Bank of New Zealand on Wednesday, which actually is going to give monetary policy update. And following on from the RBA and the Bank of Canada as well, that given policy updates that didn't move on rates, then I think the likelihood is that we're going to see a similar story with the RBNZ as well. And then you've also got the UK industrial production, but the big one comes on Thursday. We've got the US retail sales, and that data has disappointed in the last couple of months, and the potential for it to disappoint again with some pretty harsh weather conditions in the States, and also consumer confidence falling away last month as well. So it'll be interesting to see what that number comes out with. And then we finish off the week with Michigan sentiment on Friday. So not a great deal to drive markets this week. We're going to still be trading on the legacy of this payrolls report, and the market's going to be increasingly looking towards this Fed meeting, which comes in next Wednesday. Anyway, I wish you good luck in your trading throughout this week, and I will speak to you again soon. Thank you.